Have you ever stumbled upon a company that just looks perfect, like absolutely flawless on paper, but you get this nagging feeling? Is it actually a good investment right now? Well, today we're going to dig into that exact question. We're looking at a professional stock analysis of a company called Laurus Labs to really understand the difference between a great company and a great stock. Let's get into it. Okay, so to get a sense of just how big of a deal Laurus Labs is, get this. They are a critical supplier to 9 out of the 10 largest pharmaceutical companies on the planet. I mean, wow. That is the kind of reach that really makes you sit up and pay attention. So let's set the stage here. Laurus Labs isn't just some run-of-the-mill drug company. Nope. They are a massive global player in what are called active pharmaceutical ingredients, or APIs. You can think of APIs as the active ingredient, the raw stuff that actually makes our medicines do their job. The whole thing was started back in 2005 by Dr. Satyanarayana Chava. And in what feels like the blink of an eye, he's taken it from a startup to this enormous platform with a team of over 6,500 people. It's a pretty incredible story. Now, if we look at where their money comes from, the business mix is really interesting. The biggest piece of the pie is something called ARV APIs. That's for antiretroviral drugs, the ones used to treat HIV. And Laurus Labs isn't just in this market, they are a dominant force, controlling a massive 25 to 30% of the entire global market. On top of that, they're a top 5 player in cancer drug APIs and are pushing into other really promising areas. All right, so with that background, let's start building what investors call the bull case. This is basically all the good stuff, all the reasons why this company looks like an absolute slam dunk investment. First up, you just have to look at the growth. It's fantastic. Over the last 5 years, their revenues have been growing at a compound rate of 14.4% year after year. That's the kind of consistent, impressive growth that shows you this is a business that people really want and need. And the company has these incredibly powerful moats, these competitive advantages that are hard for anyone else to copy. They've got the stamp of approval from all the big global regulators, the US FDA, the WHO. That's a huge hurdle for any newcomers. They also have just massive manufacturing scale, a deep bench of over 1,000 scientists, and they can do it all cheaper than their Western competitors. It's really a fortress of a business model. And if that wasn't enough, there's this huge global trend that's basically pushing business right to their doorstep. It's called the China Plus One strategy. All it means is that big global companies are trying not to put all their eggs in the China basket anymore. They're diversifying their supply chains. And Indian manufacturers like Laurus Labs are in the perfect spot to catch all that new business. It's a massive tailwind for them. So you look at all this, right? You've got market leadership, amazing growth, these powerful moats, a global trend helping them out. It seems like a no-brainer, doesn't it? A clear buy, an open and shut case. Well, this is where this story takes a sharp turn. Because as we said at the start, a great business doesn't automatically mean it's a great stock to buy at any price. And yep, you guessed it. There's a catch. Remember that awesome 14.4% revenue growth we just talked about? Well, here's the other shoe dropping. Their profit has only grown at about 6.2% over that same period. So what does that mean? It means while they're selling a ton more stuff, they're not actually keeping as much of that money as profit. And that, my friends, is our first major red flag. And you can see this problem crystal clear when you look at their net profit margin, which is just the percentage of money they get to keep from every sale. You see it's been going down, and it's not a small drop. It's gone from over 12% down to a projected 8.6%. The pie is definitely getting bigger, but their slice of that pie is getting thinner and thinner. Okay, now for what might be the biggest issue of all. The valuation. Let's just focus on the PE ratio. The simplest way to think about it is, it's the price tag. How many dollars are you paying for just $1 of the company's earnings? Now, the average for this sector is around 28. A really high-quality competitor, Divis Labs, trades at about 43. Laurus Labs, it's trading at a breathtaking 91.3 times its earnings. You are paying a massive, massive premium for this stock compared to its peers. And the analysis we're looking at sums it up perfectly right here. The quote says the valuation is stretched. What that really means is the stock price is already so high, it's assuming the company is going to grow at these insane rates without a single hiccup. That leaves you with very little room for error, what investors call a margin of safety. If anything goes wrong, there's no cushion. So, okay, if the price in the market seems way too high, how do analysts even begin to figure out what the right price or the fair value should be? Well, this gets us to the classic idea of price versus value.
They use a financial tool called a discounted cash flow analysis, or DCF. Now, I know it sounds super complicated, but the core idea is actually pretty simple. It just says that a company's true value, its real worth, is basically the sum of all the cash it's going to generate for the rest of its life.
The whole thing really boils down to 3 simple steps. First, you try to predict all the cash the company is going to make in the future. Second, you discount that future money back to today's dollars because, a dollar you get 10 years from now is worth less than a dollar in your pocket today. And third, once you have that fair value number, you compare it to the price the stock is actually selling for in the market. That's it. So after the analysts ran all their numbers, projecting revenues, figuring out margins, and estimating growth rates, they landed on this: a target price, their estimate of fair value, of 715 rupees per share. And boom, here it is. This is the core takeaway of the entire analysis. The calculated fair value is 715 rupees, but the stock is currently trading on the market for 858. The price is significantly higher than what the fundamental analysis suggests the company is actually worth. And all of this leads to the report's final recommendation: a hold. Now, this isn't them saying, sell, 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 because it's still a fantastic company, right? But it's a very strong warning. It's saying, hold on, don't buy at this crazy high price because their work suggests it's overvalued and there could be more risk than reward right now. So this brings us right to the heart of the issue, the real dilemma that any potential investor is facing with a stock like this. You really got 2 sides of a coin. On one side, you have all the amazing positives. It's a market leader, it's got great management, it's diversifying, and it has these huge industry trends at its back. But then you flip the coin over, and you've got some very real concerns. That extreme price tag, the fact that its profitability is shrinking, and the risk that they have to be absolutely perfect to justify the current price. And that leaves us with the big final question that this whole analysis is really about. We've seen that a great company doesn't always equal a great investment, at least not at any price. So at the end of the day, it all boils down to this: how much are you, as an investor, willing to pay for quality?